All right, what's up, everybody? Welcome back to Investing Sucks. And so, in this video, I just kind of want to do a quick lesson on something that's a very prevalent issue in the market these days, and something that can have a pretty serious damaging effect on a lot of people's portfolios, specifically those that are very into tech stocks on the NASDAQ, that are very speculative and loss making companies, which is a lot of companies in the ARK Invest Innovation ETF, which is a very popular ETF at the moment right now. So, I'm going to talk about these guys a bit as well. It has to do with inflation, and I think this is an important video to make now, just as a way of explaining a risk that could exist, because I'm seeing a lot of people, or there's a lot of complaining happening online recently on investing forums about basically their portfolios getting crushed the past few weeks and them losing money on options and the like. So I just want to make this video because I know there's a lot of new investors that maybe got burned by this. So I just kind of want to get this out there, and hopefully this can be valuable information to a lot of people. So yeah, it has to do with inflation. Inflation is a bit of a hot topic right now, and I think a lot of people are speculating. I mean, this could just be one thing, but this is my personal opinion that when COVID ends and the restrictions are lifted, people have a lot of pent up savings due to the fact that they haven't really been able to spend a lot of money this past year because no one's been traveling. No one's really paying transportation costs when they go to and from work. So people are saving a lot of money. And once the economy reopens, they'll then start spending that money en masse. And this could potentially cause inflation to increase because prices could go higher and higher once people are spending more money. And keep in mind, this is just one piece of the inflation puzzle. Obviously, inflation typically being measured by the consumer price index, which some people have problems with. I mean, I personally think it's an okay measure, but yeah, this is just one piece of the inflation puzzle. So there's a lot of other things to kind of keep in mind. So it's all speculation. No one really knows what's going to happen when the economy goes back to normal. But regardless, given there's an announcement that the Fed recently made where they basically said they're okay with inflation going a bit above that magical 2% number. And it was enough to stir the pot a little bit. Basically, the key takeaway is that some people are expecting inflation to increase a bit now. So, how does this impact other stuff, specifically tech companies, as I alluded to in the title? Well, it kind of relates to interest rates. And as we know, interest rates are primarily based on three factors. So, one is repayment risk. So, how likely is the person you're lending money to actually repay that money? Meaning, if they're more likely to not do it, you're going to charge them a higher interest rate to compensate for that risk. Obviously, there's also time value of money. And the third part would be, as discussed, inflation. So, if inflation is expected to increase, that's going to drive away treasury investors, as we're seeing here, from these lower yielding treasury bonds. Because if inflation exceeds the yield that they're currently getting on their bonds, they're going to want to sell those bonds and go put their money in something else. Because obviously they would lose money in real terms. So what this caused is people to basically sell their bonds now that this announcement from the Fed came out, said inflation might go above 2%. So a lot of people worried and said, well, I'm obviously going to want to sell my bonds because if my bond is only yielding, around 1%, as we can see here, as it was during the start of the year, being 2021, and if inflation goes higher than that, there's no point holding this. So I'm just going to sell my bonds because I'm losing money in real terms. So yeah, people are selling their bonds, and then we can kind of see this trend here, which throughout 2021, this trend pushed bond yields a bit higher. So we can see they kind of just went up, and they're still kind of increasing by a lot. I mean, about 1 point. Overall, these are still pretty low yields if you're looking at it from a historical basis. I'm specifically looking at the 10-year bond because this is something that a lot of investors look at. So now let's get into the title more. Like, how is this going to hurt equities? So I mentioned tech stocks, but reality it's going to hurt all equities. And it's easy to pick on tech stocks because of their crazy high valuations for companies that are losing money. But really, it's all stocks. And here's why. Because we know that equities are valued based on the net present value of their expected future cash flows. So any increase in the discount rate at which those cash flows are discounted as will cause the value of stocks to fall. And part of this discount rate we use is the 10-year US Treasury yield. It's a pretty common measure. It's usually referred to as the risk-free rate. And this is what's built into our cost of equity formula, specifically the capital asset pricing model that a lot of people use to value equities. A lot of retail investors will use this to value equities. A lot of institutional investors will use it too. It's very, very common. So I'm going to go to Excel here, and I've got a bit of an example. So here is basically your cost of equity. So you got the risk-free rate, which I have it right now at 1%, which, I mean, at the beginning of the year, that's about what it was. You can see right here. I mean, 1% is pretty close to what it was. The market risk premium, this changes a lot. It's really just a benchmark on the S&P 500, or whatever benchmark people are using nowadays, but it's usually around 5.5%, which is like the historical annual return you get investing in the total stock market or the S&P 500 or TSX if you're in Canada, minus the risk-free rate. So 5.5% is pretty standard now. And this beta, so I got this beta from a company that I'm going to talk about. So I'm going to go through 3 companies here just to illustrate this. So one is going to be McDonald's, and I'm going to use real companies but hypothetical data. And you can see these companies are going to get increasingly more speculative in terms of what we expect their future earnings to be. So McDonald's is one. The other one is going to be Spotify, and the other one is going to be Uber. And I've listed these kind of in like my opinion, but also the general consensus of the market of how speculative these are. And we're gonna have some years here. We'll go with 10 years. So let's say that McDonald's, I mean, like I said, real companies, but hypothetical numbers. So pretend this is in millions. Let's say McDonald's is generating 100 million in cash flow per year for the next 10 years. I mean, it's obviously not gonna be that, but just to kind of illustrate the point. And Spotify. So Spotify is currently a loss-making company, but obviously people are investing in them because people believe they have the ability to generate earnings into the future. So let's say 5 years they finally generate their first cash inflow. So we'll say 20 million, and then 50 million, and then 100 million, and then it stays constant at 100 million. And now Uber's another loss-making company, I believe. I mean, I haven't looked at their financials too in depth, but let's say it takes 8 years for Uber to become profitable. And then when they're profitable, it's 100 million free cash flow. So we can see 3 companies all generating positive cash flow at different points in time. So now we're going to have to discount the values. So I'll kind of put a net present value calculation here, which is just kind of like the total. So I'll do it down here actually. So let's say we have this, it's generated 1 year from now. So we'll divide it by 1 plus discount rate to the power of however many years, which is just 1 in this case. And just label that cash flows. All right, so this is the McDonald's example. And the beta I'm using here is actually the most recent beta from McDonald's. So, and then we just drag that across. Change this to the absolute value using a MacBook, so it's a little slow. All right, and then we can just basically sum all this up. So this would be our current value of McDonald's. And then kind of what we saw, I was talking about, or the risk-free rate, going back to the whole inflation thing, because people expect inflation to go up, it's causing the yields on those 10-year treasury bonds to go up, which is what we use as our risk-free rate. So it's at 1%, but say now it goes up to 1.7%. And then keep an eye on this number here. So hit enter, we can see it dropped a bit. So as we can tell, McDonald's as a business has not changed at all, right? I mean, they're still receiving a lot of royalties from franchise fees from all their franchises. But just because of this increase in the risk-free rate, which was really caused by worries about inflation, their value went down. So that's something we have to always keep in mind as equity investors, because like interest rates have been very, very low for a very, very long time, and they're not going to go negative. I mean, some people are speculating they are. It's unlikely that they'll go negative. So really the only direction they can go is up, which who knows when that's going to be. It's tough to say, but if they're already as low as they are, they do have to eventually go up at some point, whether that's 10 years from now, 20 years from now. So it is a risk that we kind of have to keep in mind. All right, so now let's use this example, but instead we're going to use Spotify. So I'm going to go pull up Spotify and just check what their beta is so I can have more accurate data here. All right, so 1.63. So, I mean, higher, obviously, it's a more volatile stock. That makes sense. The rest of the numbers we can assume are pretty similar. And then we'll just change this to these numbers over here. And just drag it across. Just delete these so we get the sums. All right, so we have our net present value, which is about 209 million. Obviously, that's way less than what Spotify is actually worth on the market now. But let's put this risk-free rate back to 1%. So 209 million, put it to 1%. And then it actually increases to 220 million. So we can see, again, Spotify as a business has not changed. The only thing that's changed is the risk-free rate, which was really because of inflation. So it is pretty interesting how the market makes that connection. And it's, yeah, like I said before, it's something that I think like people just aren't really taking into account when they invest in these speculative stocks. A lot of people like to invest in companies that are familiar to them, and one of those is Spotify, especially young people. I mean, young people love Spotify. So now let's take it even further, which is Uber. And the key here, as we get into like a more and more speculative range, is that these companies are generating cash flow further out in the future. And what that's leading to is the further out in the future the cash flows are being generated, the more sensitive it is to changes in the discount rate, which is ultimately caused by, like I said, inflation and this risk-free rate. So at 1%, which is about what it was, if we go back here, this is about what the 10-year Treasury yield was at the beginning of the year, 1%. Now it's at 1.7%. And then their value, so it goes down. And it's not a significant decrease. So one thing that I think prudent investors would be doing is looking at how stocks are taking these hits and whether or not that actually makes sense given how they value them. So what I would hope people are doing if they're investing in Uber is really thinking about like projecting their cash flows and being, okay, at Uber's current valuation, what are their cash flows deemed to be? Like what cash flows do they need in order for their current valuation to make sense? And then once they've determined that, they can say, okay, how reasonable is it that Uber will actually get these cash flows? Because then you can kind of make that connection and say to yourself, okay, well now their valuation is way too high because these cash flows are unreasonable in my opinion, or I think Uber will get higher cash flows in this, which means they're undervalued. And then you can also change the risk-free rate in your formula that you use for the cost of equity. I mean, obviously the cost of debt is also going to be blended into the discount rate, but we'll just use cost of equity again to keep things simple. And you can say, all right, if Uber increased by this much because of this whole risk-free rate thing that we've been talking about, again, going back to inflation, were they oversold? Like, did people accurately price in into the valuation the new cost of equity? So that's something that prudent investors, I hope, are doing in today's market because it is becoming more of an issue. And yeah, it's a risk that you have to keep in mind. So let's go back and look at some of the ARK Invest, because they took a bit of a hit when this whole thing happens, because if we look at their key holdings, I mean, a lot of these companies are loss-based companies, you know, like Spotify we talked about. Shopify, I'm not sure how loss making. I mean, I'm not sure actually with Spotify. Tesla obviously has some profitable quarters. Square, I mean, all these companies are kind of tech stocks that are highly speculative but are common to people, so they're getting a lot of attention in the markets. So yeah, with all this in mind, you really just got to think about the likelihood of this whole thing happening. And let's be real, no one knows the future. And I didn't make this video to try and scare anyone away or tell people that they better sell their stocks and I don't know, go invest in like gold bullion or whatever is being called an inflation hedge these days. But obviously, diversification is always key because we never know what's going to happen. Will inflation rise? Maybe. Will nothing happen? Also a possibility. But as investors, we have to make sure we understand the risks, which is hard because risks aren't fun and we like to just think about making money instead of what could potentially go wrong. And they're stressful, but still important nonetheless. So, there you have it. That's the video. Thank you so much for listening, and till next time.